$10,000 in cashback rewards just cost you $3,700 in taxes, and your accountant probably didn't tell you. Most small business owners think cashback is straightforward income. You spend money on business expenses, your card generates rewards, and that's profit. Clean math, except it's not. The IRS has other plans. Here's what's about to happen. You'll hit the end of the year with $8,000 to $12,000 in accumulated cashback across your business cards. You'll think you just earned an extra 2-5% on every purchase. Then April rolls around, your CPA drops a line item on your tax return that says cashback rewards, taxable income. Suddenly, that $10,000 reward is now a $10,000 addition to your business income. At the 37% marginal federal tax rate for small business owners in your income bracket, you owe $3,700 on money you haven't actually collected yet. That's the delta, the gap between what you think you earned and what you actually net. According to IRS Publication 334, the official tax guide for small business, cashback, statement credits, and reward redemptions are explicitly classified as income. Not a refund, not a discount. Income. That means you report it on Schedule C, and it's subject to both federal income tax and self-employment tax if you're a sole proprietor. For an LLC or S-Corp, it's still taxable income that flows through to your personal return. Let's do the real math. You run a $500,000 annual revenue business. Your operating expenses are $350,000. You charge everything to your business credit cards to capture rewards. Let's say your average card offers 2% cash back. That's $7,000 in raw cashback for the year. But here's the tax impact. Add that $7,000 to your $350,000 in expenses. Your net business income before taxes is now $150,000 instead of $143,000. A 37% combined federal and self-employment tax rate. That's an extra $2,590 in taxes owed on rewards you haven't even received as cash. Your actual take-home from that cashback, about $410 instead of $7,000. That's a 37% haircut. Now here's where it gets worse. Most small business owners don't track this properly. They let cashback accumulate as statement credits without formally reporting it on their tax return. The IRS knows about it. The card issuer reports aggregate reward data, and buried in their audit selection algorithms is a flag for mismatched reward income. If you claim $500,000 in revenue, but fail to report $7,000 in rewards, that's a red flag. So how do you actually make cashback arbitrage work after the tax hit? First strategy, category multipliers on mandatory business expenses. Don't just chase 2% flat rate cards. Use 3x or 5x category cards on true operational costs, shipping, employee travel, software subscriptions. If you've got $80,000 in annual software and SaaS expenses, and you can route that through a 3x card instead of 1%, you're generating an extra $1,600 in rewards on the same spend. After tax, that's $1,008 net, real money. Second, sign-up bonus stacking. A single $5,000 sign-up bonus after $3,000 spend in 3 months is taxable income. But if you're applying that bonus to offset legitimate business expenses you were going to pay anyway, you've essentially prepaid those expenses with a tax-advantaged reward. That bonus still counts as income on your tax return, but you've shifted the timing and method of payment. Third, reward rate arbitrage across expense categories. Most owners use one card. Data shows that businesses using 3 strategically layered cards, one for shipping, one for software, one for travel, can capture 40-60% more rewards than a single flat rate card because they're hitting the right multiplier on each category. Federal Reserve data on small business spending patterns shows the average business has 5 major expense categories. Most owners capture rewards on only 2 of them. But here's the critical part. You must report all of it, every dollar. Not because the IRS is hunting you, they're not, but because the card issuers report it anyway. Form 1099 MISC or a proprietary rewards summary shows up in your tax file. Align your Schedule C with that number. If you earn $10,000 in rewards, you report $10,000. You pay the tax. Then you run the math on whether the after-tax yield, 3% to 3% depending on your bracket, justifies the effort and the card fees. That's the reality most small business owners don't hear until December. Cashback is taxable. The tax drag is 35-40%. And the strategies that survive that hit are the ones built around category multipliers and mandatory expenses, not chasing sign-up bonuses. The gap between expected and actual yield, $2,000 to $5,000 per year for the average $500K revenue business. That's what's at stake when you ignore the tax impact. If you want the full calculations and the tax tracking spreadsheet, the deep dive is in my book, From 580 to 800, link in the description. Your credit profile is your leverage. Protect it.